Hi, and welcome to this course on finding your investment winners from using stock screeners. What is a stock screener? Think of a stock screener as your personal assistant that filters through thousands of stocks in seconds. Rather than manually checking every company on the market, which would take weeks, a stock screener lets you set specific criteria and instantly finds matches. Popular options include FinViz, which is free and beginner friendly, Yahoo Finance, TradingView, and for Irish investors, some brokers like DeGiro, which offers a built-in screener. People use them for one simple reason, and that's efficiency. Imagine trying to find value stocks in the S&P 500 by hand. You'd need to check 500 companies, P/E ratios, debt levels, dividend yields, and so on. A screener does this in seconds using lots of criteria that you select for your own screens of things that interest you. Now we're going to look at three different stock screen setups, and the first one here is for growth stocks. So growth stocks are companies expanding rapidly, often reinvesting profits rather than paying dividends. And here is how you would set up your growth screen using finviz.com. So we pick some criteria. We'll pick revenue growth for 5 years at a minimum of 15% annually. We'll pick EPS growth for the next 5 years at a minimum of 15% as well. We'll pick the price to sales ratio under 10, and this avoids sort of extreme overvaluations. We'll pick market capitalization of in excess of 2 billion. And that gives a bit of stability. And then we will choose the current ratio above 1.5, and that ensures that the company has cash and can pay their bills. So think of companies like Nvidia, from a few years back, rapidly growing revenues and earnings, reinvesting everything into R&D. So that's your growth sort of profile. These are the Nvidias, the Teslas, these sort of type of stocks. So you're looking for the next big thing and not today's sort of dividend payer. Now this screen is a value screen setup that we've got. Value investing is Warren Buffett's style of investing. So you're finding solid companies trading below their net worth. So this is the setup that we would have, typical sort of setup that we would have for a value screen. So we're looking for the price earnings ratio of under 15, which would suggest below market average. We're looking for a price to book ratio of under 3. So it means you're not overpaying for assets with price to book. The lower the value, the better. We're looking for a company that has good cash. And not carrying a whole lot of debt. So we want the debt equity ratio under about 0.5. We're looking for dividend yields. Lots of these value stocks pay dividends, so we want a good solid dividend yield, maybe above 3%. And we're looking for return on equity above 10%. That suggests that the management manages the company well and gets good value out of the equity in the company. So here we're really looking for established companies such as Coca-Cola, Walmart, JP Morgan, Visa, Apple. These are companies that dominate their sector, their marketplace. They've really good management, and you can look at that company and you can go, yeah, I really see that company still being here in about 30, 40, 50 years time. So our final screen is a momentum stock screener. And momentum investing means riding the wave, getting on the bandwagon and really buying into stocks that are already on the move up. So here's a typical screen setup that you'd have for momentum stocks. So we're looking for performance. We're looking for telltale signs that things are on the move in the right direction here. So performance, quarterly performance up at least 20%, yearly performance up at least 30%, the 52-week high and low level within about 10% of the 52-week high. That means that we're still in or around that bubbling up of the stock price, and the wave is still going. The average volume, you want proper volume here. You don't want a tiny volume, which might suggest that it's just a one-off spike in the share price. But if you've a good amount of regular volume, so here we have 500,000 shares a day, so that's pretty good average. The RSI between 50 and 70. That shows that this is a relative strength index, and that basically shows whether a stock is overbought or oversold. So you can see whether that, again, it's another indicator of whether the wave is overdone or not yet fully done. So it gives you some idea of how much is left in the momentum. So it's really it's like spotting everyone suddenly trying to buy an electric vehicle stocks or AI companies. So it pinpoints where the momentum is for you. So now let's move on to other screening criteria that you can use to try and refine your results even more. Because sometimes you might run some of these screens, you might go from 6 or 8 thousand stocks down to 300 stocks, but that's still way too many. So you want to refine it down a little more. Other interesting ones that you can add into all of these screens is analyst recommendations. So you can filter by buy or strong buy or something like that. In Finviz, a number one rating is a strong buy, number two rating is a buy, and so on down through the scale of them all. Target price is another one to look at. It'll show you the percentage of target where it is in relation to the target price. If there's still 20% to go to get to that target price. Insider trading, also very important, because the directors of the company and the people who work in those companies, they really know what's going on. So they know when to buy and when to sell. So if you keep an eye on what they're doing, that'll give you a good idea of what might be happening. Not always the case, but it's a good sort of yardstick. And earnings surprises. So companies that beat earnings estimates consistently show strong operational performance. That's because they keep finding new markets and new ways of getting in more money. So these are other criteria to refine things even more. So while screeners are great, they're not the be all and end all of trying to find winning stocks. That comes with research as well. But so there are advantages, but there's also some disadvantages that come with screeners. So the advantages clearly are that they save an awful lot of time. They remove emotion out of filtering. They have a systematic kind of way about it, and they can very quickly go from thousands of stock down to 10, 20, 50 stocks. Now, the disadvantages is really the main one is that you're backward looking at historical data in order to come up with these criteria. So that doesn't necessarily reflect on what's going to happen in the future, but it's the best of the information that we got, so that's why we're using it. But best practice really is to use a screener for your first filter and not your final decision making. So they will limit you down to a certain amount of stocks, and then the real work starts in going and doing the research and going into places such as Yahoo Finance and some of these other really good websites and looking at the ratios, the news, the financial information that's available online now in order to really refine your search down to just a handful of key stocks that you want to invest in. And finally, as we said in the last slide, we're really at the stage now to try and refine the stocks that we have into a usable list that we can call winners that we're going to invest in. So if you've run your screener and you've got maybe 50, 60 stocks, something in that region, the next thing you want to do is you want to really start your digging around research into each of these, or at least the key ones that you want to focus on, and reduce that down that way. So first things you want to be doing is looking for earnings reports, looking at news about management, about the company, about any lawsuits, regulatory issues, customer law. They may have lost customers, they may have gained customers as well. So you just want to see what's going on in their business. Are they doing well? Or what's the tone of the business? Is it on the way up or on the way down? Or does it feel like they're having problems? Then look at some of those ratios as well, the traditional ratios like PE ratios and those sort of things. And finally, you can try and tighten up some of the criteria that you've already used, which will give you a shorter list in the first place. So things like market cap, these types of things, you could go for larger companies, because a market cap is really sort of a proxy for a better run company. So the higher the market cap, the higher you can say that the company is been better run. It's got a bigger market share, it's got bigger turnover, it's got more dominance, and in likelihood it's got a better management team. So these sorts of extra filters you can add in to try and really refine your search. But as I say, the screeners find the candidates and you have to do your analysis to find the winners. So the best of luck with that.